Welcome to Everything Futures, the podcast by Optimus Futures, where we explore the fascinating world of futures trading. I'm Anna, your host, and I'm thrilled to have you join us today. In this episode, we're diving into a crucial topic for every trader: why our instincts often sabotage our trading success. While we all enter the markets to make money, our human instincts can often work against us, leading to decisions that undermine our trading strategies. From the biological hardwiring of our brains to the psychological traps we fall into, understanding these factors is essential for achieving long-term success. Today, we'll discuss how our evolutionary background influences our decision-making, the cognitive biases that impact our trades, and practical strategies to counteract these instincts. We'll also explore risk management techniques and ways to develop emotional control, helping you trade more competently and effectively. So, whether you're a seasoned trader or starting, stay tuned as we uncover the reasons behind our self-sabotaging behaviors and learn how to overcome them for potentially better trading outcomes. Visit our site, optimusfutures.com. Let's get started. Now that we've set the stage, let's dive into the heart of our topic: the conflict between human nature and market behavior. It's fascinating how the instincts that once helped our ancestors survive can work against us in the modern financial markets. Imagine this: you're in the wild, facing a predator. Your survival instincts kick in, triggering a fight or flight response. This reaction is driven by the amygdala, the part of our brain responsible for processing fear and risk. These instincts are great for escaping danger, but not for rational trading decisions. In the trading world, fear can lead us to sell prematurely, while greed can make us hold on to losing positions for too long, hoping for a rebound. These are just a few examples of how our natural responses conflict with the logic needed for successful trading. Our brains are also wired to seek patterns and make quick decisions, essential for survival. However, this can lead to overconfidence in the complex and often unpredictable world of markets. We might see patterns where none exist, leading to decisions based on false assumptions. Consider cognitive biases like confirmation bias, where we favor information that confirms our pre-existing beliefs, or loss aversion, where the pain of losing is stronger than the pleasure of winning. These biases can cloud our judgment and lead to irrational decisions. But why do these instincts persist? The answer lies in our evolutionary history. For thousands of years, these responses kept us alive. However, the financial markets are a relatively new environment that our brains haven't fully adapted to. This conflict between our hardwired instincts and the market demands creates a significant challenge for traders. Understanding this conflict is the first step towards overcoming it. Next, we'll explore the biology of decision-making, diving deeper into how our brains process risk and how we can manage these instinctual responses. Greed is the flip side of fear. It can cause traders to hold on to winning positions for too long, hoping to squeeze out every bit of profit. This often leads to missing the optimal selling point and watching profits erode as the market turns. Greed activates the brain's reward system, particularly the nucleus accumbens, which drives us to seek more reward, often blinding us to the risks involved. Imagine a trader who has made significant gains on a wheat futures contract. Instead of selling and taking profits, they hold on, driven by greed, until the price declines. They end up losing a substantial portion of their gains. Lastly, hope can cloud judgment and lead to poor decision-making. While it's essential to be optimistic, in trading, hope can lead to holding on to losing positions with the belief that they will eventually turn profitable. This can result in missed opportunities and further losses. Traders need to be aware of these emotional traps and develop strategies to manage them effectively. Then there's loss aversion. This is the tendency to prefer avoiding losses over acquiring equivalent gains. Studies have shown that the pain of losing $100 is more intense than the pleasure of gaining $100. Neuroeconomist Dr. Paul Glimcher explains, "Our brains process losses in the same region that responds to mortal danger, making financial losses feel like life or death situations. In futures trading, this can manifest as holding on to losing positions for too long, hoping they will rebound instead of cutting losses and moving on. Consider a trader who buys a natural gas contract at a high price and it drops significantly. Instead of selling and taking the loss, they hold on, hoping the price will recover. This often leads to even more significant losses as the market declines. Next up is confirmation bias. This bias causes us to favor information confirming our existing beliefs while ignoring or dismissing information contradicting them. For instance, if you believe the price of gold futures will rise, you might only pay attention to news supporting this view and ignore warnings or adverse reports. The brain's prefrontal cortex, responsible for rational decision-making, gets overruled by the amygdala, which is more emotional. This selective attention can be explained by Dr. Peter Wason's research, which suggests that we naturally seek consistency and avoid cognitive dissonance. Imagine you've invested heavily in gold futures because you believe geopolitical tensions will drive up prices. You find articles and analysts' opinions that support your belief, but ignore signs of a potential market stabilization or decrease in demand. This selective attention can lead to holding onto a lousy investment longer than you should. Fear is a powerful emotion that can drive irrational decisions. It often leads to selling too early to avoid potential losses. When a trader sees a sharp drop in the micro E mini S&P 500 futures, the amygdala triggers the fight-or-flight response, flooding the body with adrenaline. In his book, The Hour Between Dog and Wolf, Dr. John Coates explains, fear in traders is akin to physical danger, causing panic and hasty decisions. For example, during a market downturn, a trader might panic and sell off all their holdings, locking in losses rather than waiting for a potential rebound. Consider a trader who sells a futures contract at a loss during a market dip, only to see it recover shortly after. This premature selling, driven by fear, prevents them from benefiting from the market's recovery. Experts suggest that loss aversion can be particularly detrimental in trading. Dr. Kahneman notes, loss aversion leads to decision inertia, where traders are paralyzed by fear and fail to act in their best interest. It can lead to a cycle of holding on to losses and missing out on better opportunities. Traders must recognize this bias and implement strategies to mitigate its impact. Now, let's move on to the emotional traps in trading: fear, greed, and hope. Our brains are incredible machines, but they're not perfect. They're wired to use shortcuts, known as heuristics, to make quick decisions. While these shortcuts can be helpful in everyday life, they often lead to cognitive biases that distort our thinking in the trading world. Let's start with overconfidence. This is a common bias where traders overestimate their knowledge, skills, or control over the market. Imagine navigating through a dense jungle without a map, feeling invincible because you've managed to find your way a few times before. This can lead to taking excessive risks and underestimating potential losses. When a trader experiences a few successful trades in crude oil futures, the brain releases dopamine, the feel-good neurotransmitter. This creates a sense of euphoria and invincibility. Dr. Daniel Kahneman, a renowned psychologist, explains, overconfidence arises because our brains are rewarded with dopamine when things go well, reinforcing a false sense of control. Consequently, the trader might increase their position sizes or take on riskier trades, believing they are less likely to fail. However, this overconfidence often leads to significant losses when the market behaves unpredictably. As we conclude this Everything Futures episode by Optimus Futures, let's summarize the key points we've discussed today. We've looked into how our innate human instincts, deeply rooted in our biology and psychology, can sometimes work against us in trading. From the fight-or-flight response driven by our amygdala to cognitive biases such as overconfidence, confirmation bias, and loss aversion, these natural inclinations can lead to irrational and counterproductive trading decisions. We've also talked about the emotional pitfalls of fear, greed, and hope, which can cloud our judgment and result in poor trading outcomes. Understanding these biases and emotional influences is the first step toward minimizing their impact. Practical strategies such as establishing strict trading rules, using stop-loss orders, maintaining a trading journal, and utilizing technology and automated systems can assist us in managing these biases and making more rational trading decisions. In summary, being mindful of our instincts and biases is essential for trading success. Regular self-assessment and disciplined trading practices can help us overcome these natural tendencies. Remember, trading is not only about understanding the market, it also involves understanding ourselves. Numerous excellent resources are available for those interested in delving deeper into these topics. Books like Thinking Fast and Slow by Daniel Kahneman and The Psychology of Trading by Brett Steenbarger provide valuable insights into the psychological aspects of trading. Also, could you join trading communities or seek mentorship to continue learning and growing as a trader? Before we conclude, I'd like to encourage you to share your own experiences and questions. Have you encountered these biases in your trading? How have you managed them? Your stories and insights could be valuable to our community of listeners. You can reach out to us through our website or social media channels. Lastly, don't forget to subscribe to Everything Futures so you don't miss our upcoming episodes. We'll continue to explore the fascinating world of futures trading and share more strategies to help you succeed. Thank you for joining us today. Until next time, happy trading. Do not forget to visit our site, optimusfutures.com, to explore our trading technology, margin, and pricing. This material should be viewed as a solicitation for entering into a derivatives transaction. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. This material should be viewed as a solicitation for entering into a derivatives transaction. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. The placement of contingent orders by you or broker or trading advisor, such as a stop loss or stop limit order, will not necessarily limit your losses to the intended amounts, since market conditions may make it impossible to execute such orders. The high degree of leverage that is often obtainable in commodity interest trading can work against you as well as for you. The use of leverage can lead to large losses as well as gains. Optimus Futures, LLC is not affiliated with, nor does it endorse any trading system, methodologies, newsletter, or other similar service. We urge you to conduct your own due diligence.